Hello guys, welcome to Saya Entertainment. In this video, we will talk about how to find the right IPO to invest. As these days, the share market is flooded with so many new IPOs and selecting the best or right IPO for investment can be tricky. So if you're not sure about how to analyze this, let's have a look at the following points for the long-term investment purpose. The first point is read the IPO prospectus of the company. There are two types of IPO prospectus, DRHP and RHP. DRHP is Draft Red Herring Prospectus, which can be downloaded from the SEBI website, NSE website, or the company website. Basically, the DRHP is the preliminary document prepared by the company and is submitted to SEBI for approval. This document includes the information about the company business, promoters, financials, and the IPO risk. DRHP additionally elaborates how the corporation is going to use the money raised by public issue and the viable risk for investors. Thus, investors must go through DRHP before investing in any IPO. Red herring prospectus. Red herring prospectus means a prospectus that doesn't have complete particulars on the price of the securities and the quantum of the securities. This document contains the following information: purpose of issue, risk factors, promotion expenses, about the company, legal and other information, net proceed, balance sheet, and copy of the underwriting agreement. So, what to look in an IPO? The two most important things to look before applying for an IPO is what is the size of fresh issue and offer for sale. Fresh issue of share means the new equity shares are issued by the company and selling those newly issued shares to the investors. The money raised through issuance of fresh equity shares will be used by the company for its objects and business operations as described at the time of IPO. For instance, a company has 100 shares and a profit of rupees 300. In this case, the earning per share would be 3 rupees. And if the company wants to raise capital, it decides to issue fresh shares, that is 50 shares at 5 rupees each, which helps to raise 250 rupees. Since the shares are increased to 150, the earning per share will fall to 2 rupees. And also, it leads to equity dilution, which means the value of existing investors is reduced and also their ownership proportion in the company is reduced. Offer for sale. Offer for sale means the existing promoters or investors are selling their shares. For instance, there is a company named XYZ, out of which 40% is owned by X and 60% is owned by Y. Now, X wants to decrease his stake to 20% and he sells 20% of his shares through an offer for sale. So, now the earnings made by selling the shares will be received by X, as he sold his own shares and didn't issue any fresh share. The main disadvantage of offer for sale is that the company doesn't raise any money, but there is no equity dilution in this case. So, as a conclusion, the situation where the offer for sale is greater than fresh issue is not good for the company. But if the offer for sale is less than fresh issue, that must be considered as a go ahead sign to invest in the IPO. So, before applying for any IPO, always consider these points. And next is, what should we look for in a fresh issue? The capital raised through fresh issue will be used by the company for its business. So, the company describes how it is going to use this money. Let's have a look at some of the objectives of the company for which it wants to raise capital. So, first is business expansion. For example, the company might need capital for adding new business units, hiring the employees for new factories. So, this is also a positive and go ahead sign if the company is planning to expand its business. Next is repayment of debts. If the company needs money to repay its debts, then you must look at the company's debt to equity ratio. So, if the company is not able to service the interest from its operational income, that means there are some problems. So, where company issues fresh shares to repay its debts, or if the debt repayment level is high, in that case, you should avoid going for that IPO. Acquiring other company. If the company's objective to issue new shares is to buy out the competitor to attain the monopoly, it may be a positive sign. To boost revenue, if the company is issuing shares to boost its revenue by investing in a new product, then it may be a positive sign too. Next is to fulfill the day-to-day requirements of the working capital requirement. If the company needs money for its short-term requirements because the company is not generating the operational income, though the business is which is not a good sign. So next is what should we look for in offer for sale? The very first thing to check out here is who wants to sell its shares. Is it the promoter? In case if it is the promoter who is selling through offer for sale, you must have an idea about why he is selling his stake. Is it because he wants to raise money through offer for sale and is planning to invest this money in some other business? As nobody likes to leave the company if its growth potential is high and is making profits. If it is so, this may not be a good sign. It can mean that the promoter have no longer faith in the company or the company might be involved in some foul play. Comparison with the competitors or peers. In the DRHP, the comparison with the peers is also mentioned both on the financial numbers and valuation. So before applying for the IPO, one must study the comparison of the company with its peers to check if the company's valuation are in line with the peers or not. Financial health of the company. If the revenues and profits show an increasing trend for the past few years, then it would be a positive sign to invest in the company. The financial performance helps to get an idea about if the revenues and profits are increasing or falling in the past. Next is business strength. Always consider factors like company's position in the industry, management quality, strategies, business model, etc. This can give an idea about the future prospects of the company. Pricing. Always check the pricing to avoid overpaying. Do not invest just because the company is famous. Famous companies can overprice their shares and have oversubscribed IPO. Estimating the fair price of IPO is possible through the competitor analysis. Price to earning ratio is one of the factors used for this analysis, which can be calculated by dividing the price of a company's stock by its net income per share. If this ratio is higher than the competitors, then the stock may be overpriced. A detailed analysis on the company's history and future prospects can help to take a better decision. The figures required to calculate the pricing are given in the income statement of the company. So all points are discussed here just to have an idea about what is the right way or how to find the right way to invest in IPO. So these always consider these points before investing in an IPO. So invest only if you're satisfied that the company has a strong business model, financial health, revenue potential, and management quality. Also, consider the factors like company's position in its industry, its unique attributes that prove the company is better than its competitors and will give you long-term benefits.